Good morning, esteemed clients and guest market analyst. Is that a hoodie you are wearing? How do you expect anyone to take you seriously? Anyway, today's presentation...
Goldman Sachs, they want to hold my racks.
Sorry, that was just my phone's playlist connecting to the TV. Sick line though. Mad respect. No, today's presentation is cryptocurrencies, including Bitcoin, are not an asset class. Now, I know technically they are a commodity, but it's an inflammatory line. I'm going to go with it.
Well, this should be good.
Indeed. By the end of this presentation, if any one of you have ever considered buying Bitcoin, I'm going to make you look like a total fool. Let's begin, shall we?
Yes, let's.
Cryptocurrencies, including Bitcoin, do not generate cash flow like bonds. What this means is government bonds are obviously going to get you way better gains than any cryptocurrency, let me tell you that.
Plenty of cryptos do this actually. It's called staking, but the whole point of Bitcoin is that it doesn't do this. It doesn't inflate beyond the 21 million cap.
Exactly. Terrible idea. They do not generate any exposure through global economic growth. The world is doing great right now, so you'll want some exposure. They do not provide consistent diversification benefits due to their unstable correlations.
Bitcoin is one of the most diverse asset classes because it's not related to any other market. Are you really saying that you should have no Bitcoin in your portfolio? Like really, guys, not even 1%. Nothing.
Precisely. You're getting the point, I see. They do not dampen historical volatility, which is as high as 76%. Damn. Get this, guys. On March 12th, 2020, Bitcoin fell 37% in a day.
It also pumped 40% in one day too. Let's not forget about that.
Right. Moving on. Does not show evidence of hedging against inflation.
Tell that to a Venezuelan.
Why do you say that? Do we have a Venezuelan in the office? You know what? I don't think it appropriate to bring race into this. We're an equal opportunities place of business here. We believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for our clients.
Question, if I may.
Yes?
Do you offer gold to your clients?
Yes, we do.
Do you plan to stop offering it to your clients?
No. Moving on. We also believe that while hedge funds may find trading cryptocurrencies appealing because of their high volatility, the allure does not constitute a viable investment rationale.
I think you're going to change your mind about all this, you know.
Excuse me?
I give it 4 years, tops.
Well, yeah, but by then we'll own lots of it for cheap. Cryptocurrency enthusiasts should care for what Goldman Sachs has to say about the space about as much as the CEO of Coca-Cola should care what the CEO of Pepsi's got to say. No, I can do better than that. What life advice H3 has for Keemstar? What product a salt salesman wants to sell a slug? But with all that said, you know I had to do it. The hypocrisy, once this is fully ripened, will be so sweet. Just like what happened to Jamie Dimon. You remember that guy I beat up on the streets for what he said about Bitcoin? Completely forgiven now, at least on my end. Maybe not a personal statement, but an analyst from his company claiming Bitcoin is significantly undervalued. Why does he think this? After years of being bearish on Bitcoin, the largest bank in the United States is now changing its tune about the world's leading cryptocurrency. The latest Bitcoin analysis from JP Morgan is circulated on Twitter dated May 22nd. The report from research analyst Nikolaos Panigritzoglou, I speak a little bit of Greek, but I've never heard that last name before, looks at the intrinsic value of Bitcoin by treating it as a commodity and basing a price on the marginal cost of producing Bitcoin. I've heard these theories before. I do not agree with them. I don't think they hold any water. So what if it costs a certain amount to produce Bitcoin? Bitcoin's always changing how much it costs. How can the intrinsic value of something be fluctuating so much? According to the report, Bitcoin is trading 25% below what the intrinsic price would be, following the halving event which reduced block rewards from 12 to 6. Based on Bitcoin's price when the report was published, JP Morgan placed Bitcoin's intrinsic value at $11,593. Interesting. It's nice to hear that. Sadly, I can't really agree with it though. To say that it's worth this much because that's how much it costs to produce is like saying that miners should be manipulating the price of Bitcoin up so that they can sell it at that price, which it doesn't... that makes no sense, really. But despite this, despite Goldman Sachs telling Wall Street, you don't want to get into Bitcoin for these and these and these reasons, seems Wall Street is completely ignoring the advice. Grayscale, the largest investment firm on Wall Street, is now buying 1.5 times the amount of Bitcoin being mined. As we can see from this lovely chart, Bitcoin being added to the Grayscale Bitcoin Trust since the Bitcoin halving outstrips the new amount of Bitcoin being mined. That's nice. That means if nothing else changes, Bitcoin's just going to keep going up, right? Obviously, I'm not guaranteeing that though. It can do whatever it wants. And in another interesting 180, Bakkt. Do you remember Bakkt, the backstabbers who told us that they would only introduce physical Bitcoin futures to institutional traders on Wall Street, but then introduce paper ones, which aren't good for Bitcoin? Physical ones are much better. Well, Bitcoin futures platform Bakkt now sees most of its contracts settled in Bitcoin, not cash, the latest data reveals. Nice. Two famous phrases come to mind with all of this going on. Number one being when Bitcoin OG Mahatma Gandhi said, first they fight you, then they try and buy all your Bitcoin, bro. And second, watch what they do, not what they say. And third, like, comment, and subscribe.